It's common practice to take a loan and get that car. But what if you want to change your mind and finish off that loan way before the end of tenure? While getting a loan was not really that tough, you should stop and consider a few things before deciding on a foreclosure of your loan. Hello and welcome. I'm Anukriti Bisht, a financial advisor with a leading financial institution of the country, and you're watching a learning episode on wealth management bite size. Okay, so what is this prepayment and foreclosure and how is it different? So these are two separate terms and two completely separate processes, and bank understands them way differently. Prepayment means that you've put in a large chunk of money of your loan way before the normal time, which has led to a reduction on your EMI, but your overall tenure for your loan does not really get impacted. It's just that your EMI now kind of reduces a little bit in size. So that's one thing. Foreclosure is paying off your entire loan way before the agreed terms and periods in your agreement. Now, this could be a little problematic. While your bank might have a fees for prepayment as well as foreclosure, foreclosure is something that you should really think about before really getting into it. So let's see what the considerations are. Your funds could be used somewhere else. Make sure that you have checked the kind of interest rate you've got on your car before deciding to foreclosure. If you've got a good deal on the interest rate, then maybe you're better off investing this extra money in your hand into a different market, say equity or mutual funds or any other investment options. It especially holds true in case you've got really good deal because of your company or other reasons of. Penalty charges. Penalty on foreclosure of loans varies from bank to bank. Some banks don't have any penalty for foreclosure on loans, others might have a lot of penalty. Some banks will have penalty basis also on the timeline of your overall tenure when you're doing a foreclosure. So say for example, if you want to foreclosure loan in the second year, they might charge you say about 7%. And in case you want to do a foreclosure in the third year, they might just want to charge you 2% for it. So make sure where you are in your tenure and then see if you really want to do a foreclosure or not. Also, for prepayments, some banks might only allow you to do it a specific number of times, say twice or thrice, while the other banks might not allow you to do it at all. Make sure that you've read your terms and conditions from your loan agreement before you decide what you need to do. Maybe the reason you want to do a foreclosure is because you realize you're paying a lot of EMI. How about switching to another bank? Have you really thought of that? You can choose to transfer your loan to another bank that offers a lower rate of interest. But you need to understand that this might also have an extra charge or processing fee. So it would probably be a good option to do the bank switch in case the rate of interest that the other bank is offering is really low and really makes a significant difference in your overall money. How about your loan tenure? Does that make a difference or not? Your loan tenure will also have an impact of when you're closing and the amount of savings you're getting out of it. So if you are closing your loan way into the future, closer to your tenure date, by then you've already paid most of your interest. So it will not make much of a difference on your saving. So if you're planning to close your loan, say in the second year or the third year of taking a loan, then it is still something that you can think about. Also, impact on your credit score. You would think that if you make one large lump sum payment into the bank and close your loan, it will have a great impact on your credit score. Actually, it does not. What impacts your credit score is the regular payment, because as and when you're required to pay, you doing those payments, and that is how your credit score slowly and steadily builds up. It doesn't happen because of one activity, it is because of the number of times you've done that same activity with the same kind of diligence. That repeat routine is what impacts your credit score. But that one time down payment to close a loan will only be considered as a one impact. So overall, it does not help your credit score at all. So these are few things that you should definitely consider before you decide to either prepay or foreclose your car loan. Thank you so much for watching. I hope you found the information on this episode value adding. Don't forget to like us, share us, and subscribe to us. See you soon.